Captain's log, star date 24.91, rounded off to the nearest decimal point. We've come across some interesting housing apartment numbers in which we have to analyze them and figure out if it makes a good investment. Because I've got to, mister. We're going right into this on TNT. Okay, so here we are. You have a writing utensil of sorts, you have something to write on of sorts, and we're going to go through 3 simple ways in which we analyze property. Now, the first one is primarily used with apartment buildings, and the reason why we use it with apartment buildings is because it's just meant to be a quick back of napkin. Okay, if we know that this is happening in this neighborhood, then this should go for something like this. Now, that first one is called GRM, is the acronym, and it's gross rent multiplier. Why do we use this? Again, it's just a quick rough, and it is exactly what it sounds like. It is the gross rent that a property is producing times a multiplier to get a price. Let's reverse that. If you have a price and you know the rent, you take the rent and divide it in the price and you get a gross rent multiplier. It's pretty simple, it's pretty basic. In Los Angeles, they tend to be a little bit higher than other areas of the country. I've seen anywhere from 18s to 25s. It just depends on the neighborhood and what you're buying. So, is a lower GRM better than others? Well, yes, in theory, because it means generally you're getting more cash flow for less price. But that doesn't always meet what your overall goals are. So if a property is run down and it's producing a lot of income and it's at a lower price, but you're going to have to go in and put a lot of money into it in order to get it up to value, is that really worth it? Depends on your goals. But using gross rent multiplier, you'll be able to quickly figure this out. The next one we're going to take a look at is cash on cash. Now, this one can be confusing for people because they often mistake cash on cash and our final one, cap rate. They are not the same thing. They are 2 different equations. So, cash on cash is you're taking your cash flow before taxes, that means your net operating income, NOI, which we discussed in another video, link up here if you have not gone over it. And we're going to divide that by our initial investment. So what is our initial investment? That means that we are putting in our down payment, our closing costs, any cost to acquire the property. That is our initial investment. So typically this is done, cash on cash return is done on your initial investment year. You can do it over the other years or the lifespan of an investment as well, but most commonly it's used as your initial investment. You want to know, okay, what's my return on year 1 if I buy this property, and then from there, if I can grow it, then I'll have a new cash on cash to work with. So it's a great thing to use just to figure out, again, how much return am I getting on my initial investment? All right, the last one we're going to talk about is cap rates. Now, cap rates can be confusing, and why? It's because people misapply how they're actually used. Now, we just did the cash on cash example. A lot of people think that a cap rate is how much return I would get if I bought the property for cash. This is not the case, it's a different equation. Cash on cash is the equation of your return if you bought the property for cash. So your entire initial investment into the property divided into the cash flow or NOI before taxes and debt service, that's going to give you your cash on cash. A cap rate is not that metric. A cap rate is actually the metric that's used to evaluate what a future sales price would be. And here's what I mean. This is the primary purpose of a cap rate. Cap rate there have been many people who have hypothesized that it incorporates your component of risk and your debt service and all that stuff, and it's just not it. It's just a metric to figure out how your net operating income divided by the purchase price gives you a percentage rate, okay? So it's not cash on cash if you paid 100%. And again, go back to the previous example to understand this. Because we're dividing the NOI by the purchase price. We're not dividing the NOI by the initial investment. This is the primary confusion with cap rates. Now, how do we use a cap rate? Well, if we're going to hold a property for 5 years, and let's say we buy it at a 5 cap, a 5% cap, that means that our NOI divided by the price we paid is 5%. How do we use this in the future? Well, if we're going to hold it for 5 years and we bought it for a 5 cap, and let's say we do not need to do anything to the property, it's going to maintain itself, so there's no capital improvements, we're not going to try and improve anything. The only thing that we're going to do is, per our lease agreement, is we're going to get 3% more per year. Well, if we know what the future income is 5 years from now, then theoretically we should be able to sell the property at a 5 cap again. Does that make sense? So we would take the new income and then multiply and divide it by a cap rate to get the purchase price. That's how you use a cap rate. It's very basic and very simple. The main components of investment property and investment property analysis is what benefits are you getting from the property? Are you getting appreciation? Are you getting cash flow? Are you getting a combination of the two? Are you using it for a tax deduction? All these things are important, but these are metrics that are used just to evaluate what it should and can and will do now and into the future. I hope this makes sense. If you have any questions, please put your comments down below in the comment section. And of course, if you'd like to talk more about real estate investments and how they can benefit you into the future, then reach out. We would love to help you. Happy to go over your goals, and we are looking for investors for some of our other syndications at this time. Hope you enjoy.